Today, we'll analyze the UnitedHealth Group. With its vast array of services and products, they have long been a focal point for many investors seeking stability and growth in their portfolio. And while the stock has been going mostly sideways since the end of 2021 and is trading around 10% below their all-time heights, the fundamentals and also the dividends has been growing quite a bit. Recently, first a cyberattack followed by a well-received earnings call have sent the stock on a rollercoaster ride. So if you want to know if now is a good time to add UNH to your long-term portfolio, sit back and relax, because in today's video I will dig into the business models and the markets of UNH, analyze the strategic position by doing a Porter's Five Forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation and do a discounted cash flow calculation to determine their fair value. In the end, we will see if UnitedHealth Group is a good long-term investment or not. I'm Florian. Welcome to Cashflow Maniac. UnitedHealth Group has the ticker symbol of UNH and they are listed on the New York Stock Exchange. They're working in the healthcare sector and were founded in 1974. At the moment, they have around 440,000 employees and their headquarters sits in Minnetonka, Minnesota. The market cap sits at $462 billion right now. The UnitedHealth Group is a health insurance and well-being company, and they are working in two distinct and different businesses. First, we have the United Healthcare segment, where they are mostly providing insurances for many different people, not only targeting individuals, but also companies or government agencies, for example, to provide healthcare programs to all of their employees. They are also offering a bunch of different insurances that are targeting government programs like the Medicare program, which is focused more on retired people or younger people with disabilities. So overall, with their United Healthcare segment, the company is trying to provide many different insurance programs for many different customer groups with different needs. The second segment is their Optum segment. Here, they are trying to create a high-performance, connected health system to bring together clinical expertise, technology, and data to create a more seamless consumer experience and to support doctors with insights to deliver personalized and evidence-based care. In Optum Health, they are working to empower care teams with the latest information and insights to help them more efficiently coordinate the patient's care. In Optum Insights, they want to create stronger connections between payers, providers, and consumers through software-enabled services and analytics to make the whole clinical, administrative, and financial processes in this healthcare sector simpler and more efficient. Here, they apply advanced data, technology, and clinical expertise to improve the entire healthcare experience. Optum Rx is integrating pharmacy, medical, and behavioral care, and they are trying to manage the complex care needs and provide a better and more transparent digital pharmacy experience. When we look at the revenue split by business, United Healthcare in total makes up a bit more than half of their revenue and Optum the other half. And while Optum Insights only provides a small portion of their revenue, only 3.3%, Optum Rx and Optum Health are fairly even split. The UnitedHealth Group is mostly working in the United States. The company is making most of their revenue, more than 89%, in the United States itself. And here they are the biggest health insurance company by market share. The health insurance market in the United States is a very interesting one, and it's quite different to the European one or even the German one where I am actually from. In the United States, almost 70% of the population do have a private health insurance, followed by all these government programs. Around 8% of the people are also uninsured. And while 70% of the population do have a private health insurance, the spending of private insurances is only 1.3 billion, which is around 30% of the total healthcare expenditures. These expenditures includes amount paid by insuring organizations to providers and all insuring organizations, including non-medical costs, but the majority of the spending is actually for hospital care, physicians, and professional healthcare services. The overall health insurance market in the United States is actually expected to grow with a CAGR of 6.1% until 2030. This growth in the healthcare industry has several different reasons. First of all, the baby boomer generation is reaching retirement age, so they do have an increased demand for healthcare professionals and facilities. As they get older, they get sick more often, so they need doctor care more often. In the last couple of years, there have also been many technological advancements in the medical industry, which have created new opportunities for treatments. And this has led to an actual increase for specialized medical fields, such as telemedicine, genomics, or precision medicine. This overall rise in healthcare spending has further led to an influx of investment in this healthcare industry. And last but not least, the COVID pandemic has highlighted the importance of healthcare workers and products and have increased the demand for these services. The healthcare sector overall is actually a significant driver of the US economy, and the healthcare spending accounts for almost 20% of the GDP. So this is already a very large sector, and this percentage is only to expect to increase in the coming years. In their analysis of the US healthcare sector, McKinsey actually expects the biggest growth in the services and tech sector here. The black boxes mean a growth of more than 10%, and with the services that Optum offers, UNH is covering the sector very nicely. And this is the sector where the second half of the company, the UnitedHealth sector with their insurances, is active. So the company is covering most of the quickest growing segments within this already growing healthcare sector. As I briefly mentioned in the intro, the company has been hit by a cyber attack recently. This attack mostly targeted their pharmacy services, their payment processing services, and other healthcare services, including software and analytic tools. But as of today, most of these processes and softwares have already been restored and are working close to the normal levels right now. In the last earnings call for the Q1 earnings 2024, Andrew Whitty, the CEO of United Healthcare, explained his expectations for the whole year in a bit more detail. Let's hear what he had to say.
Directly as a result of their hard work and the broad performance of our diversified businesses, we're able to reconfirm our full-year adjusted earnings outlook, even as we absorb 30 to 40 cents per share in business disruption impacts related to Change Healthcare.
So, at least for the time being, the company is still sticking to their adjusted earnings per share forecast for the full year. It is important to note, though, that later in this earnings call, their CFO, John Rex, explains the difference between adjusted earnings per share and earnings per share. And in their regular earnings per share, they will include costs directly related to the cyber attack of $0.85 per share to $0.95 per share. Before we jump into the financial analysis in just a bit, let's have a look at the strategic position of UnitedHealth Group first by doing the Porter's Five Forces analysis. At first, the threat of new entrants is low. High regulatory hurdles make it hard for new companies in this healthcare sector. And to be compliant to healthcare laws, licensing requirements, and security standards is challenging and very time-consuming. The size and brand reputation as the biggest player in the UnitedHealth insurance space gives the UnitedHealthcare Group a good standing, and the network and size of them makes it very tough for new players to enter and compete with them, especially on a similar scale. The threat of substitutes I would estimate as medium to low. The size of UNH and the diversity of the offerings over many different segments in the healthcare industry make it tough to compete against them on all fronts. The specialization of some of their subsidiaries, such as technology solutions or data analytics, may not even have a direct substitution. The competitive rivalry in the space is fierce. There are numerous competitors offering a bunch of different services to compete against UNH. Ongoing technological advancements in healthcare, like telemedicine, have even accelerated this competition here with new and innovative services. The switching costs are also not very high, which further drives the competition. The bargaining power of their customers I would estimate as high to medium. Often, the customers of the UnitedHealth Group are companies or government agencies that represent a larger group of individual patients. Due to their size, this collective purchasing power gives them a significant leverage. Some government regulations, such as the Affordable Care Act, also increase the transparency for consumers, making it easier for them to make informed decisions. UnitedHealth Group is trying to fight this power with a broad range of different services and offerings. The bargaining power of their suppliers I would estimate as high to medium. There is only a limited number of suppliers for critical product or specialized services, and this gives these suppliers quite some power. The uniqueness of these often patented and highly specialized medical products and services make it very hard to be replaced directly. So overall, there are many threats in this highly competitive market for UnitedHealth Group, but with their market leading position and their diversified products, I still think that they do have quite a strong position here. They still need to be careful though, as many competitors are trying to nibble on their market share. If you like the video so far, please smash the like button and subscribe to the channel in order not to miss my next video. It also would help me out a lot. Let's jump to the financial analysis now. The performance of UNH compared to the S&P 500 over the last year was not too good. The company has been mostly trading sidewards and only delivered returns of around 2%. Over the last 5 years it looks a bit different. Here the company could outperform the S&P 500 by quite a bit and deliver returns of 130%. I'm looking at the total returns here as UNH is a dividend payer. And over the last 10 years the company could outperform the S&P 500 by quite a bit. Here we have almost triple the performance of the S&P 500 and they could deliver more than 650% returns. The fundamentals of the company could also grow very nicely over the last 10 years. Here we see a very steady growth in total revenue, net income and free cash flow and operating cash flow, as well as earnings per share. All of these metrics have delivered a CAGR of around 11 to 12% over the last 10 years. So here we have a very stable growth. Over the same time frame, the company could also improve their margins, operating margin, net margin and return of invested capital by a little bit. And while this growth is not too big, it is still nice to see to have margin expansions here. Unfortunately, I do not know why Tradingview is not showing the EBITDA here, but when we head over to Seeking Alpha, we can see that the EBITDA has also been growing over the last couple of years, and the growth was actually also around 11% CAGR for the last 10 years. The balance sheet of the company is also not too leveraged. Here we have a long-term debt to EBITDA multiple of 1.6 after removing the cash of the company, which is also quite nice to see. UnitedHealth Group is paying a steady dividend, and we are sitting at a revenue payout ratio of around 30% with a dividend yield of 1.5% right now. The dividend growth over the last 5 years has been sitting at 16% CAGR, which is an insane value. But with the growth in free cash flow at the same time, it is still well covered and there is still room for further growth. In addition to the dividends, the company has also bought back shares steadily, and here we have a CAGR over the last 5 years of minus 0.76%. So the company is returning cash on multiple fronts to their investors. The forecast for the next couple of years also looks very nice. Here we expect an EPS growth of around 13% per year and a revenue growth of around 8% per year. Analysts also seem to be quite optimistic with the stock and give it an average upside of around 15% on a 1-year basis. And from the analyst point of view, the downside seems to be quite limited at the moment. While the long-term growth trend of UnitedHealth Group seems to be very well and intact, when digging a bit deeper into the last quarterly report, I found some points that were quite concerning on first glance. And what jumps out most is that the company reported net losses here. Compared to the same quarter 1 year before, it is down by around $6 billion. But most of this is actually coming from the loss on sale of subsidiary, which is related to the sale of the Brazilian operations of UnitedHealth Group. So this is a one-time effect and was also already communicated from the management in advance. So in the end, it's not a big red flag here. And while the revenue could grow quite nicely in the last year, the operating expenses also grew at a similar level. So when we exclude this special effect from the sale of subsidiary in Brazil, we actually come to net earnings that are very similar to the same quarter 1 year ago. Of course, this also has quite some impact on the operating cash flows, and when we compare it to the same quarter 1 year ago, it went down quite significantly. So while this is not very nice to see, I still think it's a one-time effect and it should not have a huge impact on the overall business and operations of the UnitedHealth Group. Before we sum this up and come to our conclusion, let's also have a look at the current valuation. Here we look at the EV to EBITDA, PE, and price to cash flow ratio. And especially the PE and the price to cash flow ratio are quite a bit above the 5-year average of the company. The EV to EBITDA, while a bit lower than the last couple of years, is still sitting close to the 5-year averages. So compared to its own history, the company seems to be quite highly valued right now. But we also see that the price to cash flow jumped up quite a bit after the release of the last earnings numbers. And as we just saw, the operating cash flow and the net income went down quite significantly in this last quarter. So it is not too surprising that this multiple is going through the roof right now. When we compare the UnitedHealth Group against their peers, the picture seems very similar. Here, UnitedHealth Group is also quite a bit higher valued compared to most of their peers. As a dividend payer, I also like to look at the dividend yield of the last years. And on a 10-year basis, the dividend yield of the company hasn't been above 1.5% too often. All in all, the company seems to be trading very close to the average value of the last 10 years here. The dividend payout ratio sits at around 30% and the cash flow payout ratio at around 25%, which makes the dividend payments quite secure. For my fair value calculation, I used the average growth rate that we saw over the last 5 years, for net income growth rate and also for free cash flow growth rate. I also used the price to free cash flow multiple from the last 5 years and also the PE multiple of the last 5 years, because as we just saw, the current multiples are quite a bit higher compared to the long-term average, and I would expect these multiples to return to their averages again over the long run. For the dividend growth rate, I assumed around half of the value that we saw right now, because I really don't think that the company can keep up this insane dividend growth rate over the very long run. So for my estimation, I used a value of around 7% long-term dividend growth rate here. With these assumptions, I come to a fair value of around $735, and by including my margin of safety of 20%, we come to an average of around $590 here. This is quite a bit above the current stock price of $490 at the moment, so from a fair value perspective, the stock seems to be actually undervalued. So to sum it up, while not outstanding, UnitedHealth fundamentals did show some nice and very stable growth over the last years, with a low double-digit growth in most metrics over the last 10 years. The company doesn't have too much debt on the balance sheet and is rewarding investors with dividends of around 1.5% per year and also share buybacks. Especially the dividend growth rate of almost 16% per year over the last 5 years makes it a very appealing investment for dividend growth investors. And while the current multiples are a bit high when compared to its own history as well as compared to its competitors, the fair value of the company still indicates a potential undervaluation. The company is active in a growing market, and as a market leader in this health insurance sector, they have the prime position to further benefit from this growth. The recent cyber attack did leave many investors scared, but as their CEO Andrew Witte stated in their earnings call last week, the company doesn't expect any big effects on their yearly performance, and they even kept the full year guidance. There is another negative temporary effect on the cash flow with the sales of the Brazilian operation, but again, this was already expected and announced, so no big surprise here. The high dividend growth rate, coupled with the steady growth of the fundamentals, makes UnitedHealth a very appealing investment. I also find the healthcare and health insurance market a very interesting one, and the company does have a very good position in this highly competitive market. At the moment, I am still not invested in UNH. But please, before investing, do your own research and use this video only as a starting point for your own analysis. That being said, thank you so much for watching, guys. If you did find today's analysis helpful, please smash the like button and consider subscribing to the channel in order not to miss my next video. And if you do have any recommendations or suggestions, please leave me a comment down in the comment section. I do my best to try to reply to all of them. And if you are looking for another company for your long-term portfolio, this one might just be the right one.